Hello, everybody. Welcome to the Crypto Hipster Podcast. This is your host, the Crypto Hipster, Jamil Hassan, where I bring you founders, co-founders, entrepreneurs, executives, artists, musicians all around the world in crypto and blockchain, and you name it. And I love interviewing amazing people. And today I have another amazing person. His name is Krishna He. He is the co-founder of PYOR. And we're going to get into what that is. Krishna, welcome.
Thanks, Jamil. It's a pleasure and an honor to be on your podcast. Thank you.
Thank you very much. Pleasure to have you here. Let's kick things off with the first question. It's easiest. What is your background, and is it a logical background for what you do now?
Sure. So, Jamil, I started my career 20 plus years ago. I started off, in the consumer goods space as a management trainee. Very different from blockchain, very different from financial services. This is back in the year 2000, before any of these technologies existed. And very quickly, I realized that, core technology was not for me. Even though my undergraduate degree was in computer science, and I enjoyed that, being an IT manager was not something which excited me tremendously. So I went and got an MBA subsequently. So I went to the Dartmouth College, Tuck School of Business, stateside, and got an MBA there. And then joined Lehman Brothers in New York back in 2006. So, so in terms of background, when people talk about the decentralization of money, the importance of Bitcoin, a lot of it harkens back to the financial crisis. And I had a ringside view to the financial crisis thanks to my job at Lehman, where I was at the credit strategy desk. And of course, Lehman went bust in the financial crisis, and I joined Barclays in New York. And subsequently, I moved across to Barclays in Singapore. Barclays is a British investment bank with global operations. And in my last role there, I was the managing director and the head of credit research for Asia Pacific. Along the way, by way of credentials, after my MBA, I got my CFA also. So I kind of rounded off my, repertoire of 3-letter degrees, so to say, to make sure that credentials are not a lacking thing. And after about 10 years in banking, I realized that I need to do something else in life. Otherwise, I'll not get challenged sufficiently. And that's when I moved over to fintech. And back in 2015, when I was at Barclays still, I still remember very clearly the debate about Bitcoin. Bitcoin had just, hit the mainstream headlines back in 2015. And we used to debate among ourselves as part of the research team. Is this a currency? Is this a commodity? Who should be actually writing research on this particular topic? Because in a bank, you've got a lot of structures. So first you decide which team has to cover a particular topic, and then that team has to go in and do the research. And we would debate among ourselves on whether this was a currency or a commodity, or it was something else. And the reality is, even 8 years later, the SEC in the US is still trying to figure this out, right? We still don't know whether Bitcoin is a commodity or it's a currency, or how do you actually handle it. So I guess that's the interesting part about Bitcoin. And that's when my interest in crypto kind of got triggered. In 2016, I moved back to India and spent a few years in Indian fintech. But I was always watching the crypto industry on the sidelines. I started investing in crypto back in 2017 on my personal account. And that's how I kind of got my feet wet in crypto, so to say. And subsequently, in 2021, I joined this company called CoinSwitch, which is India's largest crypto platform. So think of it like the Coinbase of India, right? So I joined CoinSwitch, and my job there was to build out new initiatives for CoinSwitch, one of which was building a new Crypto Rupee Index for India. Because what we realized is, like many markets like Korea and places where Bitcoin trades differently from global markets, India is a closed capital account, and crypto in India trades slightly differently from global crypto. So I designed a crypto index for India as part of CoinSwitch. And while at CoinSwitch, I met my co-founders. We realized that data is a big problem for global operators in crypto. You need good data as an exchange, you need good data as an investor, and you need good data, even as a researcher, right? So, and we realized when we looked for data, a lot of data in crypto was not what you would call institution grade. What I mean by that is, crypto as an asset, right, started off very retail first. It was a very mainstream asset in the sense that, it was the individuals who started investing in Bitcoin and Ethereum, etc. It was very grassroots. It wasn't institution-led. But if you look at history of financial assets, if you look at commodities, if you look at derivatives, if you look at bonds, all of these started off with institutions first and then moved into retail. But crypto is different. Crypto started with retail first and move into institutions. So the tooling, the data which is available for crypto also started retail first. So we still did not have last year, and we still don't have at this point, a set of information tools which are appropriate for institutions. For example, in the traditional finance world, right? If you are a retail investor, you probably use Yahoo Finance, Google Finance, tools like that, right? Whereas if you're an institution, you probably use a Bloomberg, a FactSet, a Capital IQ, or something which is designed for institutions, where the focus is on the quality of data, right? So we realized that the institutional tooling for data for crypto did not exist. And that's what triggered our focus to say, let's go and build something which addresses this need. Because this need became very apparent for us when the Terra Luna episode happened last year. And we did not have adequate information to provide our customers to enable them to take good decisions. And people are shooting in the dark, right? It was a pretty difficult time for the industry. And we said, look, if we have to get institutions into this asset class, we need good data as the foundation. So 4 of us left CoinSwitch to start PYOR, PYOR, which stands for Power Your Own Research. So, DYOR, which is do your own research, is a well-known adage in crypto, right? You are supposed to watch your own back and decide what you want to buy, etc. We said, look, if you have to do your research, you need to make sure that you have the right data. Otherwise, it's kind of futile to try to do research with bad data. So what we are doing is creating that infrastructure for institutions specifically to do their research. So we power your research. So we don't give you, a fully cooked meal, but we provide you all the ingredients and instructions so that you can decide what is the research you want to do, which is what PYOR is all about. And my co-founders, we have 4 of us who started PYOR, one of whom is a traditional finance person like myself. He's a CPA by training. He's worked at KPMG and multiple accounting firms, done audits, etc. So he's a very traditional finance focused person. He used to be the chief financial officer at CoinSwitch prior. My other 2 co-founders are crypto natives. So they have been in crypto from even before Ethereum was launched. They got into crypto back in 2013. And one of them has been operating crypto exchanges in India for the last 10 years now. The other co-founder of mine is more technically inclined. So he's been kind of, tinkering with crypto for 10 years after he kind of saw the Bitcoin white paper and fell in love with the idea of decentralization. So we got a good mix of crypto natives and traditional finance people as part of the founding team. And I think that gives us a very interesting advantage as we try to build this out as a data platform for institutions.
Wow. Yeah, I share a similar background to you. I was at AIG when you were at Lehman.
Of course.
I built institutional grade data centers and data departments and stuff like that. So I get it, And when I got into crypto, I said, I'm a data expert. And then you had all these kids who never worked before in their life claiming they were data experts too. So
I know that feeling. Yeah, I totally relate to that.
So there is a glaring need, I agree with you, for data infrastructure, and facilitating institutional participation in crypto and blockchain. What are some of those glaring needs in data? And then outside of the data for them to be involved, because there's also, there's a lot of concerns right now.
Absolutely. So I'll address both parts of the question. So when you look at the data needs, right, if you worked at a large institution, I worked at a large financial institution. And what we realize is that when you're writing a report, when you're writing any particular research, you're putting your name in line, right? You're putting a name online for a reputation perspective. So you don't want to be using bad data there, right? So, the quality of data becomes super important, because reputation is what is at risk, and large amounts of money, of course, right? So what is missing, what we found with regard to crypto data right now, is the fidelity of the data, the absolute preciseness in the quality, right? So if you try to go and look at any metric, let's say look at TVL, which is total value locked, or you look at number of active users on a monthly basis, on a weekly basis, right? These are very trivial data points. These are not technically very challenging. Even for these basic data points, there is no single source which is accurate, which tells you what the underlying definition is, and which is consistent across blockchains, across applications. So what I mean by that is, if you go and look at TVL in 3 different sources, you are likely to find it different across multiple blockchains, right? So the same number is not going to be there across. So what we found when we did our research when we spoke to multiple data analysts in crypto is that they spent a lot of their time trying to find the right data source rather than trying to analyze the data. So, in traditional finance, you take the information for granted. If let's suppose there is Goldman Sachs and you want to figure out what is the revenue of Goldman Sachs, you're not going to have two different numbers for the revenue. There is one number and that's the accurate number, right? You're not going to debate whether the revenue number is accurate or not. You focus on trying to decide what is the relevance of the number and how do you analyze the number rather than getting the number. So we realized that, in crypto, the consistency of data was not there. And the fidelity of data, the accuracy of data was also suspect in many cases, right? Because once you kind of are not sure about the consistency, you have to double check it and triple check it before you put your name on a report with that data. So we said solving this is important if you want institutions to come in, because you want institutions to come in knowing that the data is what they are used to in the traditional finance space. Right? So that's our effort to say that, look, when you come on the PYOR platform, you come to PYOR, you pick up your data, you can be sure this is triple checked institution grade data. This is not something which has been crowdsourced. This is not something which somebody has just pulled in and put it on a volunteer basis or a best efforts basis, right? So, it's all in-house generated. We run our own nodes. From our own nodes for each blockchain, we index the data. We have very clear definitions of what constitutes each metric, right? So if you look at what is the monthly active users for a particular DEX, is it users who are transacting? Is it users who are voting in a governance kind of a scenario? Or is it just users who have just come in, opened their wallet and gone away, right? So what is an active user? It's not clear today. Similarly, when you look at value locked, does value locked include both the supply side and the demand side for a protocol like Compound? Or does it only include one side of the transaction? Unless you have definitions which are crystal clear, it's very hard to take decisions, right? So in traditional finance, for example, if you're looking at, say, a line item like depreciation, you just want not just the number, but you also want the notes to accounts, the kind of subtext, which tells you what all went into this number. Because you, as an analyst, might want to make some adjustments. You might want to exclude some items, you might want to include some items, etc. Right? That's the way you would typically model a balance sheet, an income statement, etc. For us, we want the same flexibility to be available in crypto. So we want to provide high quality data with attribution to source. So you know where the data came from, and the flexibility for the user to make their own overrides, because each person has a different way of looking at the data. So you want to be able to have that flexibility, right? So that's what we're kind of putting together. And to the second part of your question, right, Jamil, obviously the concerns for institutions are not just about data. I think at this point of time, given what we've seen in the last 15 months, between multiple institutions going down, regulations changing and increasing, I think institutions are waiting for clarity from a regulatory perspective. Also, there is interest in blockchain, there's interest in tokenization, there's interest in crypto. And I think you don't find anybody who debates whether this is important or not. Crypto, all said and done, is still $1 trillion asset class at this point of time, right? And it is significant, it's important, and the investors are interested in it. That's what we realized. But people are waiting for clarity. They want clarity on regulation. They want clarity on how exchanges are going to treat this asset class from a trading perspective. Will it be handled by the mainstream exchanges like what you find for other assets? Will it have to be other institutions? All of this is up in the air. So clarity on regulation, I think, is going to help a lot with regard to institutional adoption of crypto as an investment asset.
So clarity and consistent base assumptions. And if we have that, then we'll have more institutional players. But tactically, some countries are moving very advanced and very forward thinking with their regulations, and some have their heads stuck in the sand. So tactically, how do we get there?
Yeah, absolutely. I think the reality is, once you got a few countries move ahead with regard to crypto regulation, right? Europe, for example, has got MiCA, which has come into force. For the next 18 months, I think you'll have a lot of providers across Europe shift into this framework and get regulated under a common framework. We've got lots of progress happening in Hong Kong, for example, right, in the last few weeks itself. So I think some jurisdictions, which happen to be financial centers, are making progress with regard to regulations. Some have kind of, stuck their head in the sand, as you said, right? Now, it's a competitive world. It's a borderless world. And I think everybody realizes that assets will flow into the jurisdictions which are most supportive. right? So, capital is mobile, talent is mobile, right? So given that it is a matter of time, I think, before we get harmonized regulations globally. I know India is a case in point, right? So, 2 years ago, there was a lot of noise about will India ban crypto? How is India going to handle crypto, etc. And this year, when you look at the rhetoric in India, it is all about, as part of G20, as the country which is leading G20 from the policy perspective, India is trying to drive global regulations for crypto. The discussion is no longer about banning crypto, but it's about agreeing that crypto is borderless. Technology by definition is borderless, so crypto is borderless. So unless you have harmonized regulations globally, you're not going to be able to actually enforce any regulation. So that is pretty well understood now. And I think you'll see a lot more headlines about countries trying to say, we don't want to, create a problem for themselves by adopting wrong or poor regulation. And there will be a move towards consistent regulation globally. And what Europe is doing, I think, is a great case in point, because once they put a line in the sand, you'll have other people trying to look at that and say, we're not going to put ourselves at a disadvantage by over-regulating crypto.
I had to forget 1 minute that you're in India and I'm in the US, and there's a lot of talk about the BRICS nations coming together and abandoning the dollar standard. And how do you think that CBDC that doesn't involve a US DC or US currency would help or hurt the crypto future market?
Yeah, that's a great question, Jamil, because what we've seen is that, look, the digital economy is actually more dollarized than the physical economy. What I mean by that is, when you look at global trade, right? Global trade is, obviously majorly transacted in US dollars, but it is transacted in euros, it's transacted in multiple other currencies also, right? So it's not, US dollars are not 95% of global trade. It's probably closer to 60 to 70% of global trade is denominated in US dollars. And other currencies also have significant share. In the physical world, if you move to the digital world, US dollar has dominance at a 90% plus level. And that has been a source of concern for a lot of countries, right? So when you look at the discussion in India, if they don't adopt a good digital currency, if they don't adopt a CBDC, if they don't make progress on the digital currency aspect of it, the worry for India, and this is true for multiple of the emerging markets, multiple central bank governors have gone on record saying this, saying that we risk further dollarization of the digital economy, which means the central bank's power gets undercut, right? So if the digital economy is dollarized, as a central bank, you are a bystander. You don't have control on what's happening. And that's something which the central banks across emerging markets want to avoid. So in some sense, that threat of a further dollarization of the digital economy is going to push a lot of emerging market central banks to embrace digital currencies much more. Now, will it become the form of a CBDC? Will they be open to currencies like a Bitcoin or Ethereum as an option? Needs to be seen. But I think the threat of dollarization of the digital economy being higher than the physical is clearly weighing on the minds of multiple central bankers as we speak.
That makes sense. Okay, so besides that, and besides the data infrastructure and threat of the dollar, what are the other current barriers to widespread adoption of crypto?
So Jamil, when we speak to institutions about how they think about crypto, right? I think regulations obviously are the first barrier. Once they get past the hurdle of regulation and they understand how to, where the regulators stand with regard to them transacting in crypto, the second barrier, I think, is still with regard to other aspects of trading in crypto. Like, what platforms do you trade in? Are you supposed to trade on a centralized exchange? Are you okay with trading on a decentralized exchange? What benchmarks do you use for your transactions, right? For your performance? How do you assess performance as an investor? How do you custody the crypto? What is the right security mechanism to be used? How do you make sure you don't get hacked, right? So a lot of these have been kind of set up very well in the traditional finance world. 40 years ago, you would use stock certificates. Now you use a depository, and we made transitions from physical to digital, etc. So all of these have happened over time. And what you see in traditional finance is a particular set of rules and regulations which have evolved over time to the current state. Crypto has evolved in an alternate route, right? So when you trade a stock, you don't settle instantly. There is a settlement process. You settle and exchange asset and cash. at a particular delay, right? It's T+1 or T+2 based upon the underlying asset. But crypto is different. When you buy Bitcoin, you typically do a swap with something else. It could be USDC, USDT, that's the typical way you would get exposure to a crypto asset, right? So settlement is happening instantly. Now, from an accounting system perspective, from a monitoring compliance perspective, all these processes, which are core to institution, and you've seen that in your time at AIG, have to be set up and assessed for crypto, right? Are they fit for purpose? Do you need to upgrade some of these processes? So all of that needs to be assessed. And I think institutions will take their time doing all of these background work, even after regulation comes into play. So my expectation is not that regulation comes in today and Monday morning, everybody is set to go. That's not going to happen, right? So it's going to take time to build those underlying blocks also.
Yeah, I see a lot of middle office and back office being set up to do this.
Absolutely. That's very required.
I would say that right now, and I want to get your perspective on this, because to me, it looks like that we're in a global recession. We may not be, but it looks like we are to me. How can digital assets in the crypto economy unlock the next generation of economic growth, and what will that economic growth look like once we get out of the recession?
That's a very interesting question, Jamil, because obviously, if you look at the current conditions, right, they're so challenging. We've seen the headlines out of the US with regard to what happened to multiple banks, what's happening to commercial real estate. There are a lot of challenges coming through. And I agree with you, we are probably closer in, more in the second or third innings of a game rather than the eighth or ninth innings, right? So we are still very early on with regard to where things are going from a recession risk perspective. That said, if you look at what is the key impact of digital assets, of the blockchain, distributed ledger technology on financial services, my belief is that you could see all of these technologies reduce the amount of friction which is embedded in the system. Right? So that's going to be one big contribution, because right now there is a lot of friction, the cholesterol which is there within the system itself, which slows down transactions, which makes it harder to transact, which creates barriers to people accessing different assets, can decrease substantially with the adoption of crypto and crypto-like technologies, right? So that's one aspect of it. Second, and aspect which is very close to my heart, is the democratization of a variety of assets through tokenization. So today, for example, if you want to get access to a private equity fund, or you want to get access to commercial real estate, you need to be a high net worth or an ultra high net worth individual, right? So you can't take $1,000 and say, I want to get access to buying a large commercial real estate property, right? So, or you want to get access to a private equity fund, there are minimum sizes which are there, right? So there are barriers to access. By tokenizing these assets, you are making it much easier to, tokenizing the assets, you can access these assets at a much lower ticket size. You could theoretically have a situation where you say, look, I'm going to put $100 a week towards a particular venture capital fund, or I'm going to put $100 a week towards buying a pool of mortgages, right? And because your transaction costs are so low, $100 investment actually makes sense. It's not going to result in friction and losses to you as an investor. And it is acceptable to the fund house, which is taking your investment. Because today, if you go to a fund house and say, I want to invest $1,000 or $10,000 in a particular fund, the reason they can't do the transaction is partly regulatory and partly cost, because the sheer cost of processing the transaction, the middle office, the back office, all the overhead of KYC and AML and all those things which we are very aware of from the traditional finance world, right? All of these are real costs, and that increases the hurdle for small investors to get invested in a variety of asset classes. So I think democratization of a variety of assets is going to be a big contribution as a result of tokenization. And second is reducing the total cost, transaction cost itself, which to me is more like a deadweight cost, right? So if you increase efficiency, that in turn can help the economy. So kind of weaving it back to your key question of what role can these play as we come out of a recession, I think you could have a more efficient world. And an efficient world will make for better growth and better prospects for everybody.
I would love to see an efficient world. So there's friction in the traditional system. I agree. The traditional players are also sending friction to the crypto economy instead of helping with efficiency, right? How do we remove that external friction and create that efficiency?
I look at the external friction slightly differently. I know a lot of people in crypto view pretty much everybody in the traditional economy as enemies, right? That's the starting point for a lot of crypto natives, saying that we want to kind of have a disruptive innovation which bypasses incumbents. That's the starting point for a lot of conversations in crypto, which I have with people who are 1 or 2 years into crypto. But having spent a lot of time in traditional finance, I put a lot of weight on the fact that there are a lot of structures within traditional finance which are there for a reason, right? So you have this whole thought concept of what is called a Chesterton's fence. So you're supposed to test why is something there before you dismiss it as a stupid thing in terms of a structure or a friction, right? So what I realize is that traditional finance definitely has a lot of friction, yes. At the same time, there are a lot of aspects of traditional finance which will be useful for the crypto asset class itself. A simple example is KYC, right? So it's very hard to argue that prevention of financing to terrorists is a good thing. Pretty much anybody who is operating a financial system has a responsibility to ensure that terrorists don't get easy financing. So now how do you make sure, okay, who in the financial services space has the most experience with trying to administer these rules? It is the traditional finance incumbents, because they've been doing this for 5, 10, 15, 20 years, right? So I guess what we need is a meeting of minds for the traditional finance institutions to realize that there is profits to be made in crypto. There is a revenue pool and there is profit pool. And at the same time, for the crypto natives to embrace traditional finance, saying that, hey, we got something to learn from you guys. Why don't we work on this together? And that combination, I think, once both segments have a common purpose, they will work towards reducing the barriers, one of which is the friction which is there.
I agree. It's interesting because I've seen in the past month and a half, I've seen, a little bit of a crypto boom, but it's not been in DeFi or NFTs. It's been in these meme coins, these not the established meme coins like Doge and SHIB, but like other things that are like purely gambling.
Mm-hmm.
And there's one website recently, the guy says you will get nothing .eth, and people sent him over $1 million and he said you'll get nothing. They gave him money. Like, how do you navigate this age of the influencer, people who don't have experience institutional grade, right? And the importance of high fidelity institutional analytics. Like, how do you bridge that? I guess it's a conundrum, or that looks like a wide divide to me, but how do you begin to do that?
Yeah, I kind of look at parallels in the equity market, because if you look at the stock market, right, you got a similar divide. You got a set of high quality companies, large caps, etc., which are the place where the institutional investors actually, buy, sell, and focus on, right? And then you got a long tail of small caps, micro caps, pink sheets, and a variety of these companies, which are, for lack of a better word, have pump and dump operators, which are not very well covered institutionally. And as an institution, you will not touch those particular names, right? Because you have, a definition, a particular list of hurdles and checklists, which qualify what you would transact in. So to me, what's happening with a lot of crypto assets is the long tail of what you see in the equity market, which is not stuff which institutions would bother about, and which frankly, for most investors is not suitable, right? It is fun to look at $10 in a meme coin and see whether it goes to 0 or 100. You can look at it as a gambling kind of a, activity, right? But you're not going to put in your 401k money into a meme coin and expect to hold it for 20 years. That's not the nature of activity, right? So I think we should bifurcate the market, just like the way you do it in equities, and say, look, there are places which are appropriate for institutions, which are the large established tokens, the established blockchains, etc. And there are aspects which are more speculative in nature, which are unlikely to ever attract institutional interest. But it is, a good, fun activity for some people. You can't stop it. You need to kind of be wary of it and make sure you don't go all in and lose your shirt, right? So that's the way I look at it from a bifurcation perspective. And these two can coexist for the longest time. I don't think we need to, say one has to necessarily get killed off by regulation, because there is some purpose which it's serving, I would argue.
Bifurcation, interesting. So in order to get there, how should we start looking at influencers then? Because the influencers don't have the institutional grade backgrounds. How do you start? Is that the way to establish institutional versus the influencer economy is to bifurcate?
I would argue yes, because we've had this issue of influencers globally, right? Thanks to social media being so prevalent and the ability to get your view across instantly to millions of people, influencers have emerged as a key, block of information for a lot of people over the last few years. Now, do you need to regulate the influencers? Should you have a particular set of qualifications before you go online? That's unlikely to happen, and it's not appropriate because, if you look at media right now, it is so decentralized. The fact that you and I have this podcast going is a good example of that, right? So 30 years ago, this would not happen. There would be no way for you and me to connect and discuss crypto, right? So I guess you can't regulate the influencers. So influencers will continue to exist, and it will be foolhardy to say that, look, only if you have a particular set of credentials can you come and talk about crypto or about any other asset class. That's very hard to administer. Education is the way to go, right? So the way I look at the, how to handle influencers is make sure that the endpoints, which are investors, individual investors or institutional investors, they are all educated sufficiently. So education has to be made more prevalent at every position of transaction. So suppose you're going to buy a coin, buy a token on a centralized exchange or a decentralized exchange, make it easy for these endpoints, the transaction locations, to provide adequate education to your customers. So for example, when I was at CoinSwitch, one innovation we did was we would put up a risk flag. So whenever a particular token or a coin or any asset became volatile, we would put up a risk flag on that particular token on the screener. And when a customer is trying to buy or sell that particular token, we would provide a nudge, right? Saying, hey, do you realize that this is a very volatile token? This may or may not be suitable for you. Please think again. Just a small nudge to force people to rethink, because a lot of people might just be getting into this, out of enthusiasm, right? So they not have thought sufficiently. So what we found is that nudge was very appreciated by people because that forced them to take a second look. And look, end of the day, it's a free world. People decide what they want to do with their money. So you cannot stop somebody from buying or selling something which is, a meme coin or something which you or I think is inappropriate. But you could help by way of education and making sure that people think through the decisions before they execute on them.
I have one last question, then I actually have two last questions. I was going to ask you. No, I have to ask you this. You said nudge. So there's a subtle nudge economy out there, right? Or it might be a little more than subtle, but there's a nudge economy. How does PYOR, from a strategic and technological perspective, help people in this nudge economy to make informed and better decisions?
So, the way we look at our mission at PYOR, PYOR, which is pure is the way we pronounce it because it gives the ring of pure data, right? That's how, we pronounce it. The way we look at our mission is we focus on institutional customers first and make sure that they have the right high quality information, right? Do we visualize a situation, say, sometime down the road, wherein the same information can be given to other platforms, which in turn can make it available to retail investors? Absolutely, yes. So, I would say that institutional investors don't need the nudge economy as much. They don't, they are much more capable of looking out for themselves without these guardrails. These guardrails of nudges are super important for the most vulnerable segment of investors, which is retail investors like you and me, right? And that's where I think, these nudges need to be put in place. Institutions are very well capable of looking out for themselves. So we just provide them with high quality data and they take their decisions. They don't need these nudges, I would think.
Got it. Thank you. So I want to thank you very much for your time today. I really enjoyed speaking with you, and this has been a great conversation. It's been good to get back to my institutional days. So
wonderful, Jamil. It's been a pleasure.
So
great talking to you too.
Thank you very much.
Thanks,
Thanks
for your time.
How can people find out more information about you, about PYOR, about what you do? How can they become clients? How can they do any of that?
Oh, wonderful. So, we have not launched our product into an open beta yet. We have got it on private beta. and we got a wait list going. So our website is PYOR.xyz. That's our website. And you can, go on the website, you can sign up for the wait list, and one of my colleagues will be in touch to get people to start testing out the product. So that's where I think is the best way to reach out to us. We are on Twitter also, but I think on the website is the best way to track what we are up to and how we are building out this product.
Awesome. Thank you very much for your time today.
Thanks, Jamil. Have a good weekend.
Too.